Welcome, everyone. I'm Angelo Robles to the Angelo Robles podcast. I'm also the founder and CEO at Family Office Association. Today, we're covering a really important issue, not just in the US, but in my opinion, globally in the community that just came up a couple of weeks ago. Archegos collapse. What this means for single family offices. And I think it means more than just the title that I'm giving it. It could have far reaching implications, which we'll get into. And if there's one person from the legal side that I would want to have on talking about this in the world of family offices, well, he's on today. I'm very fortunate to have him as a frequent guest and contributor, and that would be Thomas J. Handler, JDPC partner at Handler there. Tom, welcome back to the show.
Thank you, Angelo. It's a pleasure to be with you.
So you know that I have a lot of opinions on this, which are probably going to be somewhat controversial, but I think you're going to be far better off than me of kind of setting the stage. Let's make the assumption that some might have heard of it from afar, but are really not familiar with it. How would you lay the groundwork over the last 30 days to what has occurred?
So first, I'll start by saying that this is really an extraordinary circumstance. I haven't seen anything like this in quite some time, and it brings up a few issues that we're not used to dealing with. So really kind of fascinating. The media has been all over it. So as a threshold matter, Archegos Capital was Bill Hwang's single-family office, is Bill Hwang's single-family office. It's based in Manhattan, and he's been considered a whale among different trading companies. He's done a lot of large transactions. So individual wirehouses, trust companies, investment banks were familiar with him as being a large player.
And let's make it very clear, Tom. Absolutely, there are people like this around the world that the average person, the average family office doesn't know. And these institutions and banks made a tremendous amount of money off him. We're talking to the tune of potentially $100 million a year or more. They kind of know what's going on, but pardon my interruption.
No, that's quite accurate. It's difficult to feel sorry for major financial institutions who are expert at covering themselves. Anyone who's ever had a loan and signed a 2-inch stack of documents know just how good they are at it and how fastidious they are at protecting themselves. So to some extent, Mr. Hwang's trading, despite the significant volume of trades, was somewhat off the radar screen. And the SEC certainly didn't have an understanding of the full scope of his trading, the volume, or the magnitude. Estimates of Mr. Hwang's net worth range from 10 billion to 100 billion, and nobody really knows the exact number outside of Archegos. So the speculation has been running rampant. As it turns out, Mr. Hwang was trading some very large positions. Turned out the largest position was in Viacom, and that's been estimated at between 10 and 20 billion. I don't know what the final number is, but a very large position. He also had positions in 8 other companies that made him one of the largest shareholders of those companies. And again, this is all for his private single-family office, really gargantuan trades. It all went south when the market started going the other direction and margin calls are being made, because it turns out that Mr. Hwang, who was involved in a hedge fund in the past, was very well leveraged up, even more than many hedge funds. And so this calamitous call or implosion rocked Wall Street, and the media began picking up on it and reporting the incidents. And I think I received 4 or 5 emails from clients, in the first day asking, what does this mean for us? And so I think it's really been on families' radar screen, and there's still a lot of research and work being done on this subject. I spoke to a New York Times, Wall Street Journal writer today who's further researching the issues that we're talking about.
Well, that's a very good overview. And again, many of our audience of family offices is broadly familiar with that outside looking in. So before I get to my commentary, although I did chime in once or twice, it's hard to help that, Tom. I'm sorry. Talk a little bit about, there are regulations for direct ownership of stock, and I was very specific in the verbiage that I used there, relative to a 5% position in a public company or something called 13F. If you could describe both of those.
Certainly. So there are a number, 5, 6, 7 different regulations that could apply to a family office. The SEC rules regulate investment advisory firms, and that's very broadly defined. So purely private entities, including family offices, fall under those regulations. And the sections come up whenever someone is trading large blocks of stock. In particular, 13F relates to trading $100 million of selected securities, and they publish, it doesn't apply to mutual funds, for example, they're exempted out, but most positions are required to be disclosed, and included in that are options and warrants on those positions. It could apply to convertible securities, it could be turned into equity. And so it's a pretty broad requirement to file quarterly with the SEC and report these positions in painstaking detail, which the SEC will then reconcile with their own records to make sure it all makes sense. And the intent here is for the SEC to maintain the integrity and confidence in the US securities market. So this applies to any global stock being traded on a US exchange, and it's very broadly construed by the SEC as they construe most rules, frankly. So the issue here was that Mr. Hwang, who would have otherwise been required to file these 13F reports, was not required to file them, it appears, because his positions were pursuant to total return swaps. So there are different derivatives and structured products that can be used to create off the balance sheet transactions. And when I hear that, I think a little bit about Enron. Off the balance sheet transactions didn't work well for Enron either. But the idea is that pursuant to these swaps, the positions are actually held by the institutions from which Mr. Hwang borrowed money to do these investments. And so they did the filing of the 13F, but it doesn't disclose who the underlying owner is. So it appears that Mr. Hwang was complying with the law and perfectly legal at using these total return swaps to avoid 13F filing requirements intentionally or otherwise, and that he did not have an obligation to disclose the magnitude of these positions to the SEC. And I think the uproar and the furor is just because of the magnitude of these positions. You know, billion-dollar positions are relatively rare. Multi-billion-dollar positions are even more rare. So the fact that this was under the radar screen and known only to a few banks in part, trust companies, wirehouses, investment firms, and largely off the public and SEC radar screen was rather phenomenal. And that's what's led to the many inquiries and articles in process right now.
Yeah, I mean, some of my comments on that, like you said, as far as we know, nothing illegal. This is legal. This is what big hedge fund managers do. This was what some more aggressive billionaire traders and others in the community do. Now, was he trying to hide some specific moves? And I use that word very carefully, with swaps, just as Goldman and all the banks do in dark pools. It's not criminal, but if you know that one person, a whale, is buying that much, you may look to front run that person. So again, and I know regulations may change, it's debatable whether they should. I am not the biggest fan of more and more and more and more regulation. Many of you know I wear it on my sleeve. I'm a libertarian. That's not, do I think there needs to be some guidelines? Of course. And I think there probably needs to be, okay, I'll give into this one a little bit. The adaptation to the 13F probably should, moving forward, need to include swaps. That would be just my opinion. Tom, I'm going to go into a little bit of a sequelatory that's going to give a little bit of, from my context, more on the investing end. But before I do that, as we put a little bit of an initial bow, and I'm going to have a whole bunch of other legal questions for you, But if you want to give some context relative to what you said to kick things off, and the overview of 13F and your overview of derivatives and swaps, which again, the banks make a truckload of money. And then they claim ignorance when something goes wrong, as if they don't talk to one another and know who the big whales are. Trust me, they do. Tom?
In fact, even more so, most of these large institutions have specialty desks who do nothing but derivatives and swaps or structured products. And these people are at the top of their game. They know the space quite well. So to suggest that the institutions didn't know what they're doing is not accurate.
It's a joke. I know them. I used to work at UBS. They all talk to one another, and they wanted a part of the 100 million or so that this gentleman was paying in fees. Now, Goldman and Morgan Stanley and Wells, I guess they got out just in time. Obviously, Nomura and Credit Suisse did not, and they're taking big hits.
I would suggest that it may be fair to say that the institutions didn't get the full magnitude, because you would have had to talk to all the other institutions lending money. So I think they certainly, it would be surprising if they didn't have the big picture. They may not have had the full scope of it, but enough that they should have been well advised. And like you, I'm not a fan of over-regulation. I think regulation has gone too far for the most part. The corresponding argument is that we keep inventing new types of investments and new derivatives and new styles, and new things are coming out all the time. And it takes a complex regulator to work with complex products. So to some extent, the SEC regulation is part of the society that we live in. On the other hand, they are known for being to have incredible amount of discretion. They're known for publishing very few of their decisions or pronouncements. One district is known to take one position, and the next district is not held to the same standard. I remember we did a reverse merger pooling transaction of a company going public and got it approved by Chicago. And a month later, doing the exact same transaction for a different company, I want to say Washington, D.C., out east in any event. And that SEC office said, sorry, but we're not bound by that, and we disagree, and no, you can't do the transaction that way within a very short period of time. It's obviously very frustrating and very expensive for clients to have that sort of approach. And finally, despite the fact that they have all this discretion and few published opinions or pronouncements, there's virtually no oversight. There's no congressional, assuming Congress even had the ability to provide appropriate oversight, which I would argue they don't. But even if they attempted to, they haven't shown it. And so this organization kind of runs off on its own. And to some extent, they're judge, jury, and executioner, which is problematic in itself.
Oh, to say the least. Now, in terms of, the real impact on family offices, this is an unusual situation. Right now, there's lots of people looking to vilify the rich, and this guy was super, super rich. This is one of those rare cases, though, unfortunately, where the feedback I'm getting is most family offices are a little frustrated about the situation because they feel that in the US, they're going to have greater scrutiny. Now, like you said, very, very few of them are going to fall into the 13F and some of the 5% and other guidelines. But the perception that Dodd-Frank, the exception for single family offices in the US, may be rocked, there may be more government oversight and reporting. If you're a family or inside an SFO, this is frustrating. I'd like to get your opinion, but then I am going to say, and when I get to what I got to say, don't blame Bill Hwang for this, and I'm going to explain why. But nonetheless, what direction do you think this could head?
So, with the exception of the Patriot branches, I don't have a great deal of trust for the government. I think it was Jefferson said, always love and defend your country and never ever trust your government. I think I'm in that school of thought. So a number of the early articles written on the subject called for greater regulation of family offices. That is a knee-jerk reaction and a giant mistake. And my fear, of course, is that one of the many incompetent people in government will pounce upon it and decide to try to regulate in that area.
Because it looks good to the masses. It looks great, and it's complete garbage to do that. That's just a political stunt.
Sure, it'll help you get elected, and if you're soliciting votes from the have-nots and the Marxists, it's a great way to show how you're torturing and vilifying the affluent, because that plays well on TV and in social media in particular, where you can't even get an even view of the world. The censorship is so extreme, the bias is outrageous and should be unconstitutional, frankly. But I think the idea that they can run to the roses with this is very misguided. In part, even among billionaire family offices, few have 13F filing requirements, or if they do, they're periodic. We do have clients that have them, and we do those filings, and we do them for decades. It happens. But most family offices, even large ones, will never have a 13F obligation. On the other hand, lots of other investment entities do have 13F obligations. So if you regulate family offices further, you will have accomplished nothing, because you're hitting what I'm guessing is less than 10% of those that have to do the 13F filings. So you're going to put in a law that affects this tiny minority, and meanwhile not change the law for all those other people. That makes no sense whatsoever, and government's capable of doing this all day long because they do it often. The flip would be, if they're really worried about this and they think this level of transparency is problematic for the marketplace or for the lenders, whatever their reasons, then changing the regulations under 13F to include derivative structured product transactions that are off the books, to require those to be reported, at least that seems to be within the spirit of the law and a more reasonable approach. Right. That will actually hit the subset of people that file 13F and not inappropriately regulate family offices that are a tiny fraction of those filings.
Yeah, I mean, I completely agree. Okay, here I go. Sit back, enjoy some popcorn, then I'm going to have a lot of questions for you, Tom. Again, I am an advocate of single family offices. That's my job and what I do. For those of you that think that Bill Hwang is not a single family office, you are kidding me. He came from nothing, this guy. He worked in the industry to be top 1/100th of 1%. Personally, over decades, made 200 million, did have some issues. I'm not denying that. I'm not saying he's a great guy and he hasn't made mistakes. He has. But when he converted to a legitimate single family office, this is his money, his money. He has a separate legal entity. He has massive amounts in philanthropic initiatives. Some argue it's well over $500 million, and he employs people that are part of his quote unquote, his legitimate family office. I can make the argument that this guy is every bit the trader that a Jesse Livermore was. And many of you who are active in trading know that he probably is deemed to be the most incredible trader of all time. Went bankrupt 3 times and ended up committing suicide. It didn't end well with him. But in terms of being a trader, I'm not saying great on risk management or a great investor, but as a trader, amazing. People like this, what they say in rap is the G's, the OGs, they move in silence. You don't know people like this. I know some of them. There's more than a couple, but this guy, I think, is at a special level. So just think about that. Came from nothing, 200 million of his own capital. This is his money in this country. He creates his own SFO. And like Tom said, there's some debate whether it was 10 billion or potentially upwards of 100 billion net worth. Some of the sources I have put it at about 30 billion. So let's go with that. This guy had 150x return, if my math is correct, on 200 million in what, 7 or 8 years to 30 billion. Very concentrated, tremendous amounts of leverage, guts of steel. I was going to use a different word. And we don't know the full picture. Does he have trust outside the country? Does he have billions of dollars in treasuries? Or literally, is this everything that he has? He lived a frugal lifestyle. He kept under the radar. And I repeat, is it possible to turn $1,000, 150x return, even $1 million or 10 million? Really hard, but in tiny stocks and things, it's potential to do it. Once you get billions, to be able to do that and have that level of multiple, it's incredible. Look at what we hold Steve Cohen to, Ray Dalio, worth what, 15, 20, 22 billion. This guy you never heard of, and he's worth more. He's not combined, but worth more than both of them. Obviously not the same level of risk management. I get it. And that's going to be a big, big issue. The banks knew about this. It's completely agreed play. Everyone is going to act on it now. Reporters are often reporting the wrong information on it. This guy is a single family office. He showed terrible risk management. As far as we know, we don't have the full picture of his net worth. But this guy is one of the greatest investment traders that we've ever seen. And again, I'm going to repeat, he may not be a great person. I don't know, although he does some things good when you look him up and read about him, and risk management, just horrific, terrible. Now, a question I have for you, Tom, is let's assume that the leverage in swaps was above what his assets and net worth is. We're going to make that assumption. Do you think, and I don't think we know the answer, but in these kind of situations, did he have to give personal guarantees?
That is the question. It's probably too early to tell. We will find that out eventually. I'm guessing that he has some personal guarantees. In other cases, he does not. It wouldn't be unusual for the family office to pledge its assets or a subset of its assets for loans of this magnitude. So that could be the case. He could be in a situation where he's not personally responsible. We don't know yet. I know that the comment, one of the comments in the media was that they're currently reassessing their position and determining what their response is going to be. That will be determined in part based on how much of this he's personally on the hook for. Some of the charges in the media talked about sort of bad doing or bad faith, or trying to make it look like he's done something inappropriate. To Angelo's earlier point, I thought it was relevant that any big trader, or for that matter, hedge fund manager or private equity person, is often motivated to be very quiet about their position, because the minute your positions become obvious to others, other people swoop in, people jump on the play. They can short you to try to undermine it, or they can jump on with you and drive the price up, costing you more money. There's a lot of reasons that you would prefer to keep your personal trades private, because that's based on your personal research, your analysts, understanding of the company, understanding the market, understanding the industry, economic trends. An awful lot goes in. A lot of people, a lot of time, a lot of manpower goes into those decisions, and nobody wants to share those. So the fact that he may have been protecting those for the benefit of himself and his family, nothing inappropriate about that, because at the volume he was at, he's in the same position as many of these financial institutions, large traders, and hedge funds. So I get that. And I think the fact that many of the articles I saw were vilifying him out of the box, unfortunately, this looks like the sport of the day, where it's suddenly perfectly appropriate to vilify affluence, education, and accomplishment, or all the above, totally upside down. Bill Gates, Soros, Steve Jobs, they're my heroes. They changed the world. People in Africa can now use a cell phone. They bypass the landlines and call for a medical helicopter and save a life because of that little cell phone in their hands. They've got people to thank, and it was those people. And so now that they're being vilified by the media and pointed out as bad guys, and why should we have billionaires? Well, the only reason you have billionaires is because people took incredible risks, worked very hard, in many cases went bankrupt several times before they got to the level they're at. So geniuses, hard work, tremendous risk. They did things you and I aren't doing on a regular basis, nor do I have the stomach to do. To vilify them is just upside down. And that's what's going on. So it's just part of this banter. Why not throw them under the bus and assume bad intent and everything he did was wrong? Nothing that's come out so far has indicated either bad intent or irresponsibility, or that any law was broken. So it's too early to tell. The jury's still out, so to speak. As facts come out, we'll be able to make those determinations, but it's premature to begin to stone him without knowing what actually transpired.
Completely agree. And I may be jumping the gun a little bit, and there may be things that come out that are not going to be as positive. And again, he's had stumbles in the in the past. And the media has even messed up some of that to make it worse than it actually was. But admittedly, he's definitely had mistakes. Wouldn't my members, wouldn't me, just myself, I would love to ask him, wow, how did he choose 1 to 3 things a year that he thinks could get whatever 100 multiple on? How did he source it? How did he make decisions? How does he think critically? Apparently, I'd like to ask him about his risk management, but again, we don't have the full picture and know exactly what he owns. He might have done greater non-personal guarantees and mitigation of certain things than we think. We just don't know. And I would love to ask him, great investors do tend to be concentrated. Does he think that diversification is overrated? It's bullshit. I'm not saying I feel that way. Now, what I will say is that when I hear family offices say we're in the wealth preservation business, okay, let me go on a tangent on this one for a second. I completely hear you. You know who's going to get the Bill Hwangs? It's going to be the wealth creators that took massive risk, did really well. They're going to completely, most of the time, get Bill Hwang. But the others, and often inside the family office, wealth preservation, what? A closet, indexer and matching that, especially net of taxes and fees. And is that going to keep pace with a family that's looking to buy assets that are going up drastically in value? Listen to my Michael Saylor interview. Families buying homes, New York, the Hamptons, London, wanted to buy more stocks, buying football teams, buying art. These assets don't go up at 2 or 3% a year. Saylor said they go up 20 to 25% a year. I think that's a little extreme, but the gist of it is to preserve purchasing power over generations. You need more than just getting index-like returns, in my opinion, or getting 2 or 3% above so-called government inflation. I just don't think that works. That's me. That's my opinion. I'm wrong a lot. I'm probably wrong here again. But again, I want to shake things up a little bit from some of the traditional thinking that many of us have. Tom, I guess a question for you, and maybe a lesson to be learned, and nothing at all to do with skirting the law, doing what we're allowed to do per the guidelines as American citizens. What could have been some of the things that Mr. Hwang could have done to, if something were to go terribly wrong, that he could have had some protection relative to irrevocable trust, life insurance, private placement life insurance, offshore, start over funds? What are some things where someone like him in this situation, they could have, I hate to use that word second chance, but you get the idea.
Sure. Well, I think first off, anybody with positions that large, I think you're correct in stating concentrate for creation of wealth and diversify for preservation of wealth. That's the prevailing wisdom, for lack of a better word. I think that he had the opportunity within doing the same thing using structured products. He could have either done a collar around some of those stock positions once they reached, once you get a 200% return, maybe that's good enough. Put a collar or a prepaid forward contract around some of those positions for very little cost, nominal cost. And in fact, a cost-free collar, might have capped the upside at 30%, but once you're at 230% is pretty good, and cap the downside at losing 10%. So he'd be guaranteed of never going below 90% of the current value. That's what people do with large positions and concentrated positions. So he could have done that. And then in terms of his own structures, if he had to pledge the stocks in the portfolio that he was using to do those trades, many families will use series LLCs, and each series is independent as a separate entity and a separate tax return, a separate tax ID number, and the assets in that entity are limited to that entity. They can't implode and allow the creditor or banker to jump over the firewall to the next series. So using a series might have allowed him to pledge a chunk of the portfolio without exposing all the portfolios to all the risks, which is a common real estate thing, where the real estate developers will often do a blanket pledge over everything, despite my discouraging those kind of pledges when at all possible. But again, they're trying to build wealth and they're concentrating and taking on more debt, in my opinion, than might be prudent. And then once you've done the mechanical things you can to protect yourself, Then it falls back to what sort of structures can you use to put you in a better position. And first, there are bankruptcy exemptions in every state and territory in many foreign countries. So you can move assets in those categories. So, if you maintain a defined benefit plan or a cash balance plan or a 401k plan or 529s or IRAs, there's a whole list of things, and every state will tell you what's not covered. Insurance, life insurance in many states is totally protected or partially protected. So you can get from the state statutes everything that's protected in various states, and you slide things in that category so that plaintiffs can't get them. And federally, they tend to be protected in bankruptcy, as well as by the states, perhaps at different levels. And then finally, any family with substantial wealth, we're big proponents. There's no such thing as generally accepted financial and estate planning principles. There's no gap or APBs for what should be done for families. But if there were such a thing, our thought would be that we would suggest to families get 10% off the table out of your primary business, not correlated to what you're doing, and get it in a jurisdiction where it's going to be protected. So your choices would be to do domestic asset protection structures. You can use LLCs in only a few states, maybe 13, 14 foreign countries, where it limits the remedies. You have a better chance of hanging on to the asset, or at least negotiating with the asset. They can't just be pulled out from under you. And in some cases, you can keep creditors from access to books and records and meetings and torturing private family members. But ultimately, there's really nothing you can do in the United States that will preclude the US government from taking your money. Nothing, just doesn't exist. I've been involved in defending those cases. I've watched how it plays out, and there's no structure that the government can't cut through. Even a domestic asset protection trust, there's a limit in bankruptcy law that any transfer for 10 years can be undermined, the assets pulled back out. That's the longest statute on the planet. The second longest is Bermuda at 8 years. Most of the best asset protection jurisdictions have 2 to 4 year statutes. So a 10-year tail where the assets can be pulled back and pay your creditors is just too darn long. So in these international asset protection trusts, you have the ability to put in place a fully compliant trust, totally transparent to the US government. And yet, because of the treaty between that government and the US, and the fact they're both compliant, not on the OECD blacklist, FBI, CIA, or Treasury blacklists, a real jurisdiction with rule of law, typically common law, you can park these trusts and some amount of your money can be held there where it's totally protected from even the US government. In one jurisdiction, once a 2-year statute runs, you can't even legally bring a lawsuit against those assets. So you're out on a motion to dismiss and don't have to spend tons of money to even defend the trust. So there are some great solutions, and we typically say get 10% out and protected. If you're a $100 million family, you're going to be at 10 million. So you're not going to live the same lifestyle, but you don't have to move into your parents' basement. You're going to be okay. You have some capital left over to figure out what you need to do and start over again. You're a $1 billion family, you have 100 million. You're in a better spot. But the idea is that you don't risk or sacrifice everything, because even among our client base, we've had 6 family offices in the last 35 years just implode, gone, full bankruptcy. 720 million in AUM was the biggest. Over $500 million was the second biggest. All the others were in the hundreds of millions, and the smallest one had about 50 million in AUM, and they're gone. Class action, government proceedings, market risk, the Great Recession of 2008, 2009 meltdown. Various things out there happen. You don't know what's going to transpire, but if you've got a start over fund, you have a better chance of living to fight another day. And that's kind of the name of the game. Part of wealth preservation is don't put it all at risk. Have something left over to take care of your family.
Well, that was fantastic as a brief overview, Tom. We have covered some of these subjects on asset protection with both Tom Handler, Dan Morris, and many others. It's one of my favorite subjects. We'll have more to come. And yeah, if you're a US citizen, sometimes your state of domicile, some are going to have great homestead like Florida. A lot of families underestimate, I know it's relatively modest, but it could be better than nothing, pension plans, welfare benefit plans. You mentioned 529s, IRAs, life insurance, especially more offshore, structured in trust, a domestic and international trust. And again, we could do a really deep dive into that at another time, captive insurers. And one of my favorites, a little more skewed to tremendously large families, and that would be out of the country bank ownership. There's like 30 banks for sale right now in Switzerland, some of them surprisingly relatively cheap. They're antiquated. I'm not saying they're making a lot of money, but they do need to be capitalized. And that is very protected by the government of Switzerland. So there are strategies. I mean, I deal with these phone calls almost every week, a chance to listen to the stories and, and share some of the relationships I have, like Tom and some international, to be of value to my relationships and my families. I suppose two things I'm going to say. I'm going to read, and it would help if I could give credit to the party. I'm sorry, but I don't have that. But those involved in hedge funds like Chuck and some others that are live, they would completely get this. Risk taking is a key reason that billionaire Michael Platt decided in 2015 to convert his hedge fund, Blue Crest, into a family office, and many have done that, saying that the demands by institutional investors for lower risk products constrains his bet. Once you start to become successful as a hedge fund, and a lot of your assets come from institutions, especially pensions, they don't want volatility. They want you to play it so safe, to barely hit a single. And a person like that, who's such an Machiavellian, a trader, this is constraining them. Yeah, they become billionaires, but they're unhappy. So since the firm is now a single family office, a legitimate one, I might add, they've had several years of internal gains of 50% or more. They could be more concentrated. They could take certain unique niche bets. They don't have to worry about placating the LPs and as much government oversight. So do you want the best investors to just all say, the hell with this, we're just going to be, our own single family office? That would not be good for many investors into that, or single family offices that want to invest in people like that. The other thing that I want to say, and I know some will chuckle and say, you got to be kidding me, Angelo, you're already shocking me with some of your comments during this podcast. Let's just take Mr. Hwang. Let's say he's practically totally broke. Again, I told you earlier what this guy accomplished from nothing, and his net worth being greater than some of the most iconic names that took decade after decade after decade to do it. Imagine a $1 billion family office after the dust settles and we get some more clarity. I'll give you that. Saying, Mr. Hwang, come to Palm Beach and come meet with me. How about we set up an investment vehicle, just you and I, so I'm not talking about any outside capital. You made this from 200 million, I'll put 200 million into it. My expenses come out first. We'll make an arrangement for getting my 200 million back as soon as possible, depending on profits, and effectively we'll 50-50 the rest. Now, I know you're not going to stay with this kind of arrangement forever because he's probably not that kind of guy, but if this provides him the opportunity, and he's in 3 to 5 years, you can't tell me that a person like this is not going to be successful again. Hopefully he learned a lesson on risk management. That's debatable, because look at Livermore, and 3 times in and out, in and out, in and out. And at one time, that guy Livermore, I believe, coming from nothing was worth $100 million, like in whatever, like 1902. That would be like the Bill Hwang of today, like whatever, 30, 40, 50 billion, maybe more. You can't tell me that there's not a wealthy wealth creator, because no one else is going to do it. It's going to be a wealth creator that will approach him on that. Well, how do I know this? Because I've already had a phone call. When I sent out my social media post last night, Angelo, do you happen to have Bill's email? I think I could get it. He's probably not going to listen to me. And this person's like, man, I probably want to wait till some dust settles, but I want to meet with this guy. And I basically got to the point of it. It was basically what I just said here. So hopefully you found this insightful, everyone. Normally I'm a little more cool and calm. Sorry if I felt like I was a little bit charged up today. I'm a great advocate of the SFO. Bill Hwang is definitely unique. I'll give you that. And I want to get the full picture, but this is a single family office. And again, I believe he's getting to some degree railroaded, and that is strictly my opinion, which has been wrong many times before. Tom, I'm going to give the floor to you in the final 2 or 3 minutes, if you want it, to kind of put a little bit of a bow far more eloquently than I ever could on the situation.
In looking at what we know so far, it appears that Mr. Hwang is being vilified, and that may turn out to be perfectly appropriate, but not based on what we've seen. So it seems to be premature. You have to admire the entrepreneurial spirit and the magnitude of the risk that this gentleman was willing to take. I don't have the stomach for it, so God bless him. I think the commentary that this incident militates toward regulation of more regulation of family office is really misguided. From my comments earlier, it's the wrong target, and it hits just a tiny subset of people that have 13F filing obligations. If they have to regulate anything, they could potentially find a way to include these off the balance sheet transactions. But Mr. Hwang shouldn't be vilified for doing exactly what is legal, at least so far, and complying with the existing law, which he appears to have done. And I'd love to meet him and have a chat with him as well. I think he'd be an interesting person to speak to and find out how he got where he is. So we'll see how it plays out. It should be very interesting to watch, as it has been already. And I'm hoping the government doesn't do the wrong thing and move toward regulation of family offices when that's really not the solution, if in fact there's a problem here.
They will probably try, especially currently what's going on in Washington. And not just me, yourself and organizations like mine will hopefully be able to have a chance to present the argument on behalf of the family offices and how many of them came from nothing, built amazing businesses, paid gazillions of dollars in taxes, employed so many people as a collective, give money to philanthropy, do so much good to their community, the country, and really the world. And unfortunately, again, this is not the time and place where that's been respected. You're going to get me on a tangent, Tom. Why don't I probably just stop there before I probably get in more trouble? There is a question that came in. It's a little bit of a generic, open-ended question, and I know we're going to be a little short on time, but could the family office implosions that you mentioned prior, the 6 that just completely blew up, could they have been avoided? Well, hindsight's 2020, but if you had to maybe pick 1 or 2 of them, what are ways or things they could have done to possibly avoid that?
So the class action was unavoidable, but had that client been more compliance conscious, or his general counsel been more compliance conscious, it wouldn't have been as catastrophic as a result. The largest case could have easily been avoided. They made a number of mistakes and were very reluctant to use structures out of their own state, and their state had very bad laws. So they were mystified. There were articles about this using South Dakota trusts and Delaware LLCs and so on and so forth, none of which are very exotic, but seemed exotic to the people of this particular state. And had they better diversified out of the state and out of the industry they were in, and had a startover fund, which they could have easily done. And this is a family that I think they implemented almost every recommendation we ever made over a period of 20 years. And the one exception would be the International Asset Protection Trust that we advised them to do and get 10% of the money set aside. Had they had 10%, they'd have 70+ million left. So they'd be okay, not in the position they were, but they would be all right. In the case of the federal government regulatory proceeding, there's not much the client could have done. He had 3 full-time in-house counsel, sophisticated compliance counsel, just making sure they were doing things right. There was a horrible judge, relatively incompetent, shouldn't have been there, elderly, got in for the wrong reasons. Federal judge, I was in front of this judge, it was painful. And they took the testimony of felons and people that got fired and people that committed fraud on their application. It was really a travesty. There'll be a book written about that particular case probably published before my client or right after my client dies. And I've told the client if he doesn't, I'll write it because the story needs to be told, and just how far the government overstepped. And that individual actually had put in place 2 international trusts. He'd gone down there, we'd signed him, we were all set to fund him, and this government proceeding hit, which then precludes us from going any further. There's nothing you can do at that point. You just have to stop. So he was within weeks away of having $500,000, I'm sorry. In his case, it would have been $5 million tucked away, which again was not going to be the lifestyle he had at 500 million, but he would have been fine. And he's now back today. He's probably a $40 million guy. He's never going to be a $100 million guy in, but I'm amazed that he came back from that. So I would say in the vast majority of families that had serious difficulties, or these 6 that completely imploded, 80 to 90% of them were preventable without doing anything extraordinary.
Yeah, I mean, I get in trouble when I say this, but why not again? The biggest risk to the wealthiest of the wealthy families, effectively, it's the government. It's confiscation, it's regulatory, it's railroading in and really pushing things. It's potentially antitrust for the super large ones. It's civil forfeiture. There's lots of things that could go wrong, which is why a lot of families from both political aisles of great wealth, as I started to talk more about this, reached out to me and basically said, my God, like, what do you know that we don't know? A couple of them, I made intros to Tom and others. I'm pretty connected in Switzerland. So some attorneys that buy and create banks there and set up offshore insurers, that was a big thing. So, use me if you're a member. If not, I'm still happy to be a resource and maybe point you in the right direction. 2 people sent in texts. I'm going to briefly address them. Again, I probably should ignore both of them, but it's hard for me to do so. I'm really pumped up today. Angelo, you're making it sound like the rich people are just so amazing. They do nothing bad. There's tremendous good people, very rich people, very average, and some, I don't know, 5 or 10% that are bad. The same thing in the middle class and the same thing in the poor. Just because you're rich doesn't make you a good person, but it absolutely does not make you a bad person either. That's ridiculous. There's really, really bad people who are poor. Trust me, I know, I met some of them. The other thing that I wanted to mention, I decided not to bring it up today. I did talk about it in my IG, that's Instagram post for those who don't know. And Tom would probably disagree with me on this one, but I do think there was a little bit of the fact that he's Asian. Not to the effect of maybe government coming down on him, not that way, but he's not getting the respect that he should get as a trader. And I look at some of the people that got railroaded, and some of them rightfully so, Raj, and I'm forgetting his last name, and others in the industry. Well, I don't know, they looked a little different than many others that may be in a position of authority. And by the way, how come it's never spoken about? Cathie Wood is one of the greatest investors who ever lived. She is crushing people with a bigger name than her, and she's building an amazing organization. Now, I would love to have her on. She always tells me no, or her team. And no one's perfect, but what I am saying is there's lots of people that are whales, that are incredibly successful, that are among the world's greatest investors. Now, her we become more familiar with, and a lot of them look different. Be open-minded. There's lots of tremendous opportunity there, and people should be gauged and treated not on their race, creed, or religion, by simply the quality of person that they are. This guy came from nothing and built wealth that is practically unsurpassed. I could make the argument that he might have been more liquid in his own way than like a Bezos. Like, use that as an example. He can't liquidate $30 billion of stock in Amazon. That would, the Amazon stock would completely tumble. I mean, it's pretty amazing what Hwang did from what I know so far. It may come out a little more nasty as things come out, but I'm not holding back. You're getting my opinion. Sometimes I'm probably a little too neutral and careful. You did not get that today. You got it all. I am off to Miami. That's why maybe I'm a little bit charged up as well. I am hosting roundtables. We have great speakers this Friday, Mandarin Oriental, very much looking forward to it. And New York City, I'm hopeful for this summer, not big events, intimate roundtables. I do these digital multiple times a week. I love them. I got much more of a global audience than ever before, but I miss the interactivity of face-to-face. And it's been exciting in the last 5 or 6 weeks to get a little bit back in the swing of things. We have really big plans for this year, and I have amazing guests both at my physical events and digital, some of the biggest names in the industry. So stay tuned, lots happening. I'm Angelo Robles. I'm the host of the Angelo Robles podcast, but hopefully more of you, at least my members and family offices, know me more as the founder and CEO at Family Office Association. Check out our website, inquire into membership. We're familyofficeassociation.com. And as you now know, I'm pretty active on social media. From Instagram, we're Family Office Association, to LinkedIn, to definitely the one I given most attention to because of our digital programming, and that's YouTube. You could find me, but the easiest way is simply Family Office. That's my channel there, Family Office. I've gone on too long. Tom, you were a great, great guest as always. I have so many reasons for needing to have you back as this situation evolves, and to so many others on the things that you're just so masterful at talking about and really dropping incredible knowledge onto people. Everyone, thank you so much. Look forward to the next time.